If you look at fixed income, it's going one way. Equities are going the other way.
Yeah.
I mean, is actually the search for yield in the fixed income market skewing radars all across the board?
Yeah, I think there's a couple of things. I think the hunt for yield is definitely a factor in the fixed income markets, no doubt. You see that in the flattening of the curve. You see that in yields in Europe in particular. But I also think what's happening is that we have a geopolitical risk moving into the real economy, and central banks are reacting to that, right? They're trying to kind of stretch out the cycle, if you will, stretch out our growth cycle. And so what you see is this kind of extraordinary, right, extraordinary rally in fixed income relative to equity markets or relative to any other equity market. I mean, the broadest global bond index up 9% this year, right? I mean, it's pretty unbelievable given where we started yields really at the beginning of 2019. I mean, so much of that is the willingness of central banks to pivot dovishly, and to, the Fed being obviously a big part of that.
Scott Thiel, what does it mean for commercial banking? I refuse to believe these nominal low rates won't affect European and American finance. What will you see there?
Well, I mean, I think that's the big question, Tom, right? So, like, when we look at the level of rates and what they call the kind of the reversal rate, so when does the level of rate become so low that it actually kind of has a negative impact on kind of loosening of financial conditions? And obviously the banking sector is where that becomes incredibly relevant. And you see that in the underperformance of some part of the financials as we look through the course of 2019. So there is no doubt that the shape of the curve and the level of rates is a concern for banks overall. Obviously, I don't think we're anywhere near that kind of reversal rate in the U.S., but clearly with front-end rates in Germany going to push to minus 100 at some point, we may be getting close.
What does that mean for German banks? And actually, is it something that the ECB could really look at, or do they just forget about it? Because even the tiering doesn't help that much.
No, I don't think that they forget about it. I think that what probably the ECB is charging itself with is the broader question of how do we continue to stimulate economic growth and the pass-through to inflation without using the interest rate channel any longer? Not without, but with something else with it, right? And so the idea that we have is kind of this coordination of fiscal and as well as rates. And so I think that will be an important evolution of the ECB, particularly under the new leadership as we roll into the year.